David then on the website. He's saying, I have some health and tech stocks in my 55 to 65 allocation that are not paying dividends. Newly added HC47. I'm looking at the reallocation for the new allocation model and consider the notes on the sidebar on the site. I see one tech such as TE22 that is paying and is down but on the broad list. So why are there non-paying stocks on the buy list? And I'm 55 years old.
Sure. Well, there's always going to be non-dividend paying stocks on the buy list because we have allocation models from people as young as 10 or 20. You know, the first model starts at 25 to 35, all the way up to your 80 and 90-year-olds. So we have to find appropriate companies that are going to be good for every single model that we have out there. So what we tend to do with our coding system is that we will highlight the stocks that are just as you described, dividend paying companies that have consistent and safe dividends. We'll highlight them in blue. So if you're an income investor, then that's what you're going to gravitate towards. So in the technology and the healthcare sector specifically, it's really hard to find many stocks at all that pay good dividends. So those are going to be the sectors that are going to provide more of the growth for your portfolio. Because unless you are just a straight income investor, you need some growth in your portfolio, especially in the environment that we're in right now with such high inflation. So your real rate of return is whatever your rate of return is minus taxes and inflation. So right now you could even be making a 6 or 7% return and still be negative when you factor in inflation and taxes. So there's always going to be growth stocks on the list. There's always going to be income stocks on the list. It's just your responsibility to be able to differentiate those with the descriptions about which one is the right one for your portfolio.